This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets.
Saudi and Russian supply cuts are expected to keep feeding into stronger oil prices, but any runs towards the $100 a barrel level are likely to be short-lived as economic risks linger, a Reuters poll showed on Friday. A survey of 42 economists and analysts forecast Brent crude, currently holding just above $95 a barrel, would average $84.09 a barrel in 2023, up from August's $82.45 consensus. Brent, which has averaged around $81.94 so far this year, is projected to average $86.45 in 2024. U.S. crude is seen averaging $79.64 a barrel this year, above last month's $77.83 forecast, and $82.99 a barrel in 2024.
India's oil imports from Russia rebounded in September after hitting a 7-month low in August as prices fell against Middle Eastern oil, preliminary trade flow data from LSEG, Kpler and Vortexa showed. India, the world's third biggest oil importer and consumer, also raised imports from Iraq while taking less Saudi oil, the data showed. Price competitiveness favors Russian crude, and if the Indian refiners want to take term volumes from the Middle East, they seem to prefer Iraqi barrels as Basra Medium continues to be some $2 per barrel cheaper than Arab Medium or Arab Light, said Victor Katona, lead crude analyst at Kpler.
Moving on to the top news in the energy sector.
High domestic wholesale gasoline and diesel prices mean Russian refiners are unlikely to qualify for subsidies known as damper payments this month, Reuters calculations showed on Friday. The refiners are already struggling with a fuel export ban, announced by the government on September 21st. To try to tackle the rise in local prices, the price of I-92 gasoline grade for the European part of Russia on the St. Petersburg International Mercantile Exchange, SPIMEX, averaged this month at 64,080 rubles per ton, exceeding the cutoff price for the subsidies by almost 1,500 rubles.
Record volumes of refined products were shipped from Singapore to Mexico in the third quarter on lower U.S. exports to the Latin American country caused by peak summer demand and slow shipping through the Panama Canal, industry sources and analysts say. The trend could continue into the fourth quarter, especially for gasoline, drawing down Singapore stockpiles and providing a floor for Asian refiners' margins, the sources added. Singapore's exports of diesel, gasoline and jet fuel to Mexico were at 178,000 to 208,000 metric tons on average per month between July and September. Ship tracking data from Kpler and LSEG showed, a level unseen over the past 4 years. Next, we have the top news in metal markets. The London Metal Exchange's clearinghouse will cut the minimum size of its default fund, which exists to cover outstanding debts of members who default on payments, to $1.012 billion from $1.031 from October 2. The reduction in the fund's minimum size announced on Thursday, the second within 31 days, suggests less volatile trading of industrial metals such as copper, aluminium, zinc, lead and nickel. In August, LME Clear announced changes to the way it sets the minimum level of the default fund.
Robust demand from the solar industry and limited supply growth from mines will buoy silver prices once the period of higher global interest rates is over, analysts said. Silver is both an investment and is consumed in the manufacture of jewelry, electronics and electric vehicles, as well as solar panels, which has been gaining traction amid the global green energy transition. However, silver prices, at $23 per troy ounce, are down 4% so far this year as elevated global interest rates discourage investment in precious metals, which do not offer interest. The U.S. Federal Reserve hardened its hawkish posture on interest rates last week.
We will now look at the top news in the agricultural sector.
Malaysian palm oil is expected to trade between 3,700 to 4,500 ringgit, $790 to $960 per metric ton from now until mid-2024, as an El Niño weather pattern threatens supplies amid rising demand from the food and biodiesel sectors, industry analyst Dorab Mistry said. Benchmark palm oil futures on the Bursa Malaysia Derivatives Exchange closed at 3,766 ringgit a metric ton on Friday. The trajectory of palm prices will depend on the severity or otherwise of the upcoming El Niño, Mistry, the director of Indian consumer goods company Godrej International, said at an industry conference Globoil in Mumbai on Friday.
That is all for today's news on commodity markets. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.